Dave, what's going on, man?
Hey, Tyler. Good to see you again this month.
Likewise. Excited
Yes.
to be diving into this today. Last time we were talking about buy boxes and how to figure out what you should even be approaching. What are we going to be diving into today?
Yeah, today we're talking about how we find real estate deals that are actually worth your money. So there's a lot of real estate deals you can find. A lot of them are
well, especially in today's market, it's tough to make anything pencil.
Yes, certainly. So we're going to dive into that. Last week or last month, I said we really went through what is your strategy, what kind of deals you want to be looking for, and really identifying your buy box. We had some people that were filling out your buy box form to get a very clear image of, hey, this is what I want to be doing, and these are where I see opportunities. So that was good. And now we got to dive into really how do you go find these deals and how do you find stuff that's really worth your time and money and effort you're going to put into it. Right. So.
Yeah. I mean, it's so important, especially in a market like this. I mean, look, I'm a big believer that it's always a good time to be buying real estate. It just depends on how you're approaching it and how you're finding the right deals, because you can find a deal in any market. It's just a matter of how you're doing it.
Yeah. So I want to get started and just go through kind of compare and contrast your strategy, my strategy on how we're going out and finding opportunities. On our side, first of all, it's not like public markets or stocks where you can go to Yahoo Finance and just find an endless amount of stocks you can go through, and they all have a ton of information. Real estate, I mean, you got to go collect all this stuff on your own. And the hit rate, your hit rate really, it should be pretty low. My company so far this year, we've only closed 3 deals, but we've fully underwritten 136 deals. And we have 600 contracts. I had to look at 1,000 deals out there to get down to buying a handful. And the numbers are really it's been consistent in my experience that you're going to be looking at a huge number and only closing probably 1% of them to fit exactly what you want to be looking at. So you see the same kind of numbers, Tyler?
Yeah, I do. And I was going to say, I mean, I think it should be that way, to be honest with you. And the more that you dial in your approach, the more sophisticated you get, the more deals you're going to pass up on, right? Because there's not an issue of, are there deals out there? It's really, is the right deal out there? And what's the deal that's worth our time, right? Because every deal that you do consumes investor capital, that consumes your balance sheet, that takes up time invested from the team to make sure that you're doing it right. And so you want to be picky. You want to pick the 1% of deals that you're looking at to make sure that you're absolutely maximizing all of your effort.
Yeah. And let's talk a little bit about just how you even get the deals to come in the door at first. A lot of it, there's so much information out there. There's a whole slew of ways you can find opportunities that are out there. There's tons of apps. I mean, even Zillow has commercial stuff and random apartments and smaller deals that'll somehow get into there when they're not really supposed to be there, right? And LoopNet, there's a ton of listings posted, and even MLS stuff that you can do with a broker. So you really got to build a bunch of different funnels to collect information, so you don't rely entirely on one. You need to have a lot of ways that information is coming in the door so you can see it. We've had a lot of luck looking at expired listings where we're going into a LoopNet or even MLS on the commercial side and saying, hey, what's expired? What didn't transact? And let's call those people and see, what happened with this deal? Why did it not work? Why could it not get sold? And see if there's a deal there.
Yeah, I think there's so much opportunity there. I mean, one, I can't wait to start seeing the Zestimates for commercial properties. That'll be hilarious if they ever start actually leaning in and trying to value commercial properties. But two, just a little anecdote from earlier this week, actually, that really leans into that. I was having lunch a couple of days ago with a buddy of mine who had looked at a property that was on the market for $1.9 million, smaller deal. And, they liked it, but they didn't like it at 1.9. So they kind of just waited. Well, it went off the market, and it stayed off the market for a few months, and he decided to reach back out. He ended up making an offer of $1.1 million, and the seller accepted it. And so when you are paying attention to those off-market deals, or the deals that didn't sell when they were on market, typically you're dealing with a seller that may just be tired of the asset. They may not necessarily be in a distressed position. In this case, the seller was leaving the state and just didn't want to deal with it anymore. And they had the right offer come in with a shorter close. And they said, you know what, we'll take it. And that was actually a couple $100,000 less than what they had paid for it 12 years prior. So you can find some pretty phenomenal deals that way.
Yeah, a lot of that goes into, sourcing just communication channels, but then continually following up. They got that deal because they saw it. They probably tracked it a couple times. They had it on their list of, here's something I'm interested in, and they're following back up with them. It's kind of a relentless cycle that it just has to happen if you really want to find deals that are worth your time.
Yeah, I agree. And here's the thing too that I've been thinking about a lot more here recently. I mean, look, we have never had more access to data, more access to software, more access to AI and all these tools in commercial real estate that I think some operators are leaning on too heavily. They're becoming too digital. They're trying to stay on their computers and not get out there in the real world. And I think where it really starts to change is the investors that are willing to take the more analog approach, the relationship building approach, the long-term approach. That's where you're going to start to see some pretty phenomenal deals, right? Picking up the phone and calling these sellers, going out and meeting them in person, taking like what I like to refer to as the sniper approach instead of this massive shotgun approach. That's, there's some pretty amazing deals that you can turn over that way.
Yeah. So I've never been a big fan of like the mass approach to finding deals. Like, hey, we're going to pepper the entire market and see who will sell me something. I'm sure you do too. I get texts all the time that are just generic texts of like, hey, we want to make an offer on your building. Like, you don't even know where it is, right? It's like,
you don't even know what the NOI is.
Yeah. Like, why would you even do that? So I don't think that could be really generating good results. But, the approach of, hey, you got to go out and actually look at stuff and build those relationships with operators, with managers, with brokers. So you can, one, just track what information you're getting. I'm a big fan of like, and it could be as simple as an Excel sheet that says who you talk to, what information you got, what deals you're looking at, and see really where you get good information. Like, see where you're getting information that you can make decisions on and is useful. And if a channel isn't producing insight for you, it's not helping you narrow down your investment options or learn something from it, it's like you got to move on from it.
Yeah.
And keep looking for new information channels.
I agree. And I think that also collecting your own data and having your own data sources is going to be paramount moving forward, because look, everybody has access to LoopNet. If a deal goes on LoopNet, everyone else and their grandmother now has access to that deal, right? Same with, your construction costs and things like that. I mean, one thing that I have a mastermind called the CRE Accelerator. We've got 163 members across the country. And one thing that we've been working on for months now is compiling all of the construction budgets for every project that members have done across the country. Compiling, time to lease. What is the absorption rates of all of these different products that we're seeing across the country? What are the lease rates? What are the concessions? Because you can't necessarily just go out and find that data, but when you're aggregating it all together, I mean, just imagine how much more powerful our deals become because we have all of this, right? We know what a roof should cost in Florida and Pennsylvania because of that. And so we can use those averages to figure out like, okay, well, if somebody's doing a roof, down here, it's probably going to cost us X plus one up in Tennessee, right? And that data just becomes more and more important. And so when you're looking, like you guys are at 1,000 deals, I mean, just imagine the experience, the knowledge, the data that your team is gathering as they're doing that, even on deals that they're passing up on.
Yeah. Yeah. And we've used our deal underwriting and our actual performance when we look at what is our expense ratios, what are we seeing on taxes, what are we seeing on electrical bills. We use all that on like a per square foot basis to then put that back into our acquisition, our underwriting. And even if we don't do the deal, even if the deal is a bust, we still go through the underwriting process and see what we can learn from it. Because every time you look at a deal, there's something you can learn on how they're doing it, why are their numbers vastly different, or what are they doing with rent wise? You can see what's happening and then really add that into your knowledge bank. So a lot happens just from going out and looking at the deal and underwriting it yourself and keeping your own scorecard.
Yeah, keeps you sharp too. The more you're actively underwriting, because I mean, look, the environment and the market is changing every single day. So if you want to be the best investor possible, you've got to be underwriting and looking at deals every single day.
What do you think about going and seeing them? I'm a big fan that you've got to get out there and actually walk a property to understand what's there.
So the only deals that I am comfortable not getting out and physically walking myself are the single tenant net lease deals, right? Like you and I have done some Taco John's together. We've done, y'all are doing some Dollar Generals. Those kinds of deals, you can kind of get away with a property inspector going out, taking some photos, because really at the end of the day, it heavily relies on the lease, which we can analyze from anywhere. But if you're looking at anything that's remotely value add, which is going to be the overwhelming majority of opportunities out there, you got to get boots on the ground. If nothing else, if it's not for the building, maybe you could say, okay, well, a building inspector, the property conditions assessment will tell me everything that we need to know about this. There's something to be said for standing on the property and watching how things flow. And I don't just mean like tenants coming and going. I mean, how are people interacting on the street outside, right? How much traffic is there? What does the visibility look like? There's some things that are just tangible that you can't really see from online. I'll tell you this, one of our clients was out, he's in California. We just helped him buy a 24,000 square foot mixed use facility up in Grand Rapids, Michigan. And he asked me, he was like, do you think that I need to get out there and see this? Well, it's a value add project. So naturally I said, yes, I think you should go spend some time in it. And they have a coffee shop tenant that's in one of the spaces. And so I said, why don't you do this? Why don't you just go sit in that coffee shop for a few hours? Don't put your headphones on and just listen to what's going on. And he called me a couple of days after he got back from Grand Rapids. He's like, dude, you're never going to believe this. I heard people coming in and raving about the coffee shop and telling, the checkout people, how much the baristas, how much they loved this coffee shop. And it made him feel so much more comfortable moving forward with that investment because the community was buying into the coffee shop that was there, right? Like that's something you can't put in an offering memorandum.
Yeah. And it's invaluable information when you actually get out and go see it. If you want to find a deal, like, kind of title this, like, we'll find a deal that's worth your money. It's like, what better way to tell? If you're going to put money into something, why not at least go look at it?
Yeah. But yeah, I mean, look, if we're spending $5, $10, $20 million on something, it's probably good to spend a couple $100 on a plane ticket and a hotel to get out there and see it. So speaking of which, what are the metrics that you're looking at today that make a deal worth it for you?
One of the big ones, and an issue we're seeing just in the market as a whole, is we'll underwrite stuff on paper. There will be leases there, and they may have a good amount of term left. But when we go look at that deal, that lease is not being executed, right? Like there's not a viable business that's there actually doing it. And you're kind of like, wait a minute here. Like imagine they go check out that coffee shop and there's no coffee being sold and there's no customers. It's like, this is not going to work. So there's a lot of kind of dead leases that are out there that first thing we're trying to do is make sure like, hey, we want to look at this deal. We want to make sure that all of these tenants are actually there and operating and performing. And we really got to do that. We got to be there and go see it and kind of prove it to ourselves. And we call them just kind of as a customer and see like, are they there? What's it look like? So that we're big on the commercial side, underwriting the cost to replace a tenant and knowing what that is. I mean, you can have a tenant that's been in there 20 years, but it's like, how much is that going to cost to turn that if they do leave? The same thing applies to multifamily. If you've got a really long tenant in an apartment unit and you go to renovate that, and it's going to be time consuming and expensive on a per unit basis based on just what's the general condition of the tenants that have been there. So we spend a lot of time trying to assess what is that cost of turnover going to be and how long is it going to take. And that really just comes from the experience we've had of like, what do we know we can get done? What vendors do we have? And it's very specific to us and our vendors and our team for what we can execute on. It's not up to someone else's numbers could be what they are, but if we can't do what they do, or we don't have those teams, or we do it differently, we're going to have a different number. So we got to be true to ourselves on what we can do and what our numbers are. But a big portion of what we're looking at on a deal is it being used? And then what is that cost of turnover going to look like as we forecast things out?
Yeah, I mean, just because a tenant's paying today doesn't mean that they're going to be paying tomorrow. Even if they've got that lease. I mean, I've got on the property management side, because, you and I have a property management company together. We've got a tenant here in Nashville that the landlord built it out for him as a gym, great little space. Guy was totally fine for about 6 months, and then all of a sudden stopped paying rent. Okay, well, that's a brand new lease, right? So how do we approach this? And fortunately, we've got a great team. We've been able to negotiate with them. He's making half payments until we can get the space released. But those are the things that you've got to keep in mind. Like, yes, we want to underwrite to the best case scenario, but we're not going to buy a deal on a best case scenario. Like, we hope that it performs to that. But you have to have these, X factors built in of like, okay, well, if the worst case happens, how do we handle that? Because it does. It happens. There's road bumps.
Yeah, more often than not, your plan B, C, and D are the ones that are actually getting executed in a real estate deal. So you gotta go through that sourcing, all those conversations to find out, how is that plan going to work? One other thing we've had a lot of benefit with is in operating a deal and finding that kind of like next solution in it and making sure the deal's worth the money is just talking. The more you're talking to people that are in the community working on this stuff, the more they can share their experience of, what are some other options that they did. And I think that's invaluable when you're looking at how do you underwrite a deal and you come up with your A plan, but then the next 2 or 3 renditions of it, your B, your C, your D plan, and making sure those all pencil out. So at least give you some options.
Well, and that's really what we covered last month too, right? Is make sure that you've got an operator that knows what they're doing, because anybody can underwrite a deal and make it look good. Anybody can put an offering memorandum together and make it look good. But when things go sideways, and we're seeing this, we were talking about this before we went live, we're seeing this a lot in the multifamily world today, right? Of operators, there's a couple down in Texas that have popped off, I guess, in national commercial real estate news for losing a lot of investor capital. And you're investing in the team at the end of the day. So make sure that you're investing with the right team that knows how to operate these deals and knows how to approach that kind of stuff, because it's not a matter of if you're going to hit a road bump, it's a matter of when on every single deal.
Yeah. And it always varies of what that cause could be across all the different asset classes, and understanding what those risks, you got to underwrite what those risks could be and know them going in ahead of time.
Yeah. So what investment metrics are you underwriting to today? I mean, historically, we've always looked at like an 18 to 22% IRR with a 2 times equity multiple over roughly a 5-year period. Sometimes that happens in a 3-year, which we're always excited about. Are you still seeing deals like that in today's market? Have you had to shift y'all's underwriting approach? And
yeah, our underwriting right now, just with the current state of the market, it's there's not a whole lot of movement. So it's not that easy to buy stuff. It's not that easy to sell stuff. So now we're looking at what do things look like if we have a longer hold period. Throughout the lifetime, our hold period has been about 4.5 years. Try to be right around that 5-year mark. But we have a lot of deals now that are approaching 7 or 8 years because it's not a great market to sell. So now we have to underwrite, like, what does it look like for holding this thing longer? And even going in, we're always like, hey, if we are buying a deal, if we have to hold it forever, will this work? We don't want to be in a situation where we're forecasting, hey, we have to sell this deal in 2 years for this to work. So we're very much putting in there like, hey, we're going to buy a deal, and we're saying, look, one of the scenarios is we have to just operate this thing indefinitely, and can it produce cash flow? The longer you hold something, the more it just crushes your IRR on any deal. So that kind of hurts the overall return portfolio, picture of it. But right now we're very focused on if we have a deal, we got to be able to hold it a long time, 7 years, because that's kind of what we're seeing in the market right now. That may shift. It's going to be a totally different market in 5 years. But with the input we have right now, that's what we're putting in there.
Yeah, and that's why I always tell the investors, like, hey, make sure you're looking at the equity multiple as well, or the annualized cash on cash, because I get, oh, we all want to operate on IRRs, but at the end of the day, we're not private equity firms and hedge funds. You know what I mean? Like, we're not institutional capital. And so, yes, IRR is important. But even if you're getting a lower IRR by holding it for 7 years, what you're not necessarily accounting for in that is, well, if we sold in 5, we would have been break even. You would have gotten your capital back, right? Yep. Instead of, if we hold it for 2 more years, we double your money, or we 2.5 times your money. I mean, our hotel in East Nashville, we've been in it for about 5 years now, really about 4.5, and it's going to be probably another 3 years. We sold our investors on a 5 to 7 year period, and it's probably going to shape up to be 8 to 10, depending on how the market is. And everybody's understanding. It's great, which is, it's always really nice to have investors that totally get it. I mean, especially in a market like today, like, you can predict a lot of things on a deal, but it's hard to predict some of the things that have happened in the past, 12 to 24 months. I mean, really 48 months with interest rates and everything. But they get it. It's like, hey, we could sell today and return your initial investment, but I don't think anybody's excited about that. We just need to hold it for a few more years. Here's where it's going to break even and start cash flowing. And then when we sell, we're going to close to 2.5 to 3x your money. So it'll be worth it.
Yeah. Yeah. When we look at, finding those deals too, I mean, there are some owners that are not going to hold that stuff and they're going to sell it. Right. So, and that's when it might not be now. So a lot of this deal flow is conversations that produce fruit 12 months, 18 months, heck, 3-4 years down the road, when someone does come to the position that they want to sell. And in my world, to go back, we look at our CRM of one of the conversations we've had that led to that deal, led to that opportunity, and then make sure we kind of, we put our time and energy and effort into those conversations that yield the most result in the long run. But it's definitely a long game. There's no shortcut to building relationships and deal flow.
Yeah, if you're looking to get rich quick in commercial real estate, you're in the wrong industry. You can get rich quick patiently, but you got to have the patience side of it. So, I mean, it's interesting what's going on out there. We're seeing, there's billions of dollars of debt coming due this year. There are going to be some distressed buyers. I think that there's a little bit of uncertainty for sure out there in the market, but this could be one of the best times to be buying. I mean, we were talking about an apartment complex that was worth probably $6 million down in Texas, prior to the last, I guess, 2 years with interest rate hikes and all that kind of stuff. And now it's going under contract for closer to $2 million. So there's a lot of really good opportunities out there. What's your strategy for going out and finding deals like that?
Yeah, the ones that are coming back, it's mostly all that stuff is coming through a broker relationship, in the sense that most of those purchases, where they're maybe in a bad spot right now, they bought that. There was 98% of the time, there's a broker on both sides of that transaction. Their first call is back to that person they bought the deal with, either on the buy side or the sell side, and saying like, hey, this is the issue I'm running into. Like, what can we do here? And then, so really maintaining those conversations, those relationships, is where that broker will be like, hey, we got a client who's in a little bit of pickle here. This is what they're trying to do. Is this something you would be willing to step into and work through? And we have a lot of our deal flow that comes from those situations. That's the best thing we found to get them. That is
so I hear this. We've all been hearing this for years now. Like, oh, there's going to be this massive moment where distress hits the market and a ton of opportunities are going to be out there. And everybody's been sitting there going, well, I haven't seen any of that yet. And that's exactly why, right? These brokers are moving a lot of these deals off market because those sellers call a broker. They say, hey, I need to get this moved quickly. And I know I might lose money, or I know I might be, selling for less than what I believe it's worth, but I've got to get it off the books. go find me a buyer. So, I mean, like in your experience, is that what you're seeing happening today? Is that why these deals are not actually hitting the market?
Yeah, that's why they're not going to. Now we saw, we actually lost on a deal at the end of last year where, end of 25 is a great commercial deal here in Atlanta, competitive. There were only really 3 people bidding on the deal, 3 people that worked through it and underwrote everything. And we all had pretty similar pricing, meaning basically like our investment models all looked the same. The one group was able to close and do their deal in about half the time as, Greenleaf and another competitor that was out there. So they got the deal. They were able to go faster. I'm pretty sure they basically bought all cash and refinanced it later. But they were able to move quick. And the biggest point for the broker is like, guys, who is the certainty of close that will get this deal done? The seller wanted to exit it by the end of the year. That was a big part of their requirement, and this group could do it, so they got the deal. So
yeah, man. I mean, having that, I hate the term dry powder, but I mean it's true. Having the dry powder in reserve to be able to move quickly, I mean, there's pros and cons to that, right? The pros are maybe you can get a better deal than you normally could, but there's also some cons of moving too fast. And I like not breaking the machine that we've built to make sure that we're still doing the right deal. You know what I mean? Yeah. Dave, looks like we got a question from Gilbert. He's saying, what are the biggest red flags that tell you a deal is overpriced, even if the numbers look good on paper? That's a good question.
Yeah. Everyone thinks that they have a great deal when they're trying to sell it. They're like, hey, this is a good deal, and this is why you all should pay more for it. This is why this deal is special. So one of the biggest red flags is when I hear about how special something is, to me, I'm like, there are a few real estate assets out there that are special, probably not ones that you and I are buying that are like actually special, right? So to me, that's the first sign that like they've got an inflated opinion of how much their deal is going to be worth, right? So
yeah, I think too, when there's too big of a value add upside, and because I always sit there and go, okay, well, I mean, if the seller could make $2 million more by just signing a few leases, why don't they just do that?
Yes.
Right.
Yes.
Like sometimes like the opportunity being too big, it can be too good to be true.
Yeah. Another one is the test lease where they've got a bunch of vacancy. They're like, hey, we just signed one lease at this rate, and now that means the whole thing is valued at that rate. It's like that's not the case. That's not going to happen. That's not reality. So that's another big red flag of what it looks like. And then another one is if they cannot produce actual financial statements. If they're like, we do it this way, we just write it down this way or that way. It's like, no, like you need to actually produce some form of financial statement, right? It doesn't have to be the most robust, but you've got to have something. If they don't have that, but they're basically saying they do, that's a red flag too. So that's a couple of the ones where we see that there's red flags out there. But we got another question here too: is how do you determine if a market still has upside versus being at the peak of its cycle?
It's tough because this honestly, in my opinion, isn't necessarily a market issue. I think it's a deal by deal issue. Like you might have to get granular into a street by street basis to determine where the upside is. Like, for example, in East Nashville, there's a couple of major corridors that run through this side of town. Well, there's one where land is worth $4 million an acre, and it's tough to assemble a lot of land. And there's one where it's worth closer to $1.5 or $2 million an acre, right? So I just compare that and I go, well, overall in the market, like, option A, I think is overpriced, but option B is still a hell of a steal. Like, let's go on that corridor and see what we can get because they're 2 minutes apart, right? I also think that, when you're looking, like a big telltale sign of things are too overheated is when you start seeing a lot of vacancy. I mean, honestly, like you start seeing too many signs of space for lease, and that's because the supply has started to outrun demand, right? And so that to me would say it's probably at the peak of its cycle. What do you think, Dave?
Yeah, when we're thinking like, hey, how much more runway does this area have? We like population growth, but that information is more like city specific ish, maybe some neighborhood specific areas or smaller segments. But I think it really goes down to like, hey, is this street going to perform well or not? And really that goes into like, what's the city 5-year plan? Like, are they going to add sidewalks on this one side of the street, and now the retail here is going to be doing a lot better? So much of that determines how much upside is left in a specific market. So we look at it pretty granularly to see where that is. But then also at the peak of the market, a deal you underwrite, literally every single thing, every metric has to be like at that edge of breaking for a deal to work. And you're like, look, that's too many things have to go right for this deal to work. So that's where we kind of hop off. I'm like, hey, if I got to literally do every single thing right for this deal to produce an average return, to me that says the market's too overpriced, too hot.
It's too much work and too much risk for the return. It's like, man, there's easier deals out there. The other thing that I always look at too, office is so easy to beat up today because everybody's like, oh, well, it's 18 to 20% vacancy nationwide. It's like, okay, well, maybe San Francisco is like 40%. I don't know the actual numbers. It's probably an exaggeration compared to what it really is. Downtown Nashville, higher than it used to be. But then you start getting into these, sub-markets, right? Like, Midtown Nashville, occupancy is super high. You start going out towards the suburbs, occupancy is super high. And so it really comes down to like not just the overall market, but the sub-market, and then, like you said, street by street or neighborhoods.
Yeah. You could look at that and say some of the downtown, really old office space. Just because the Class A building in the town is doing well, that like Class C multi-story office, it might never come back, quite frankly, right? So it's like, is there value there? It's like maybe not.
So, well, and it probably shouldn't come back. I just think that office is going to do fine. I think here's the thing. Retail had its, big moment, 10-ish years ago, right? When e-commerce came around, they had to completely change their approach, and retail evolved into something new, right? Same with industrial. Like you look at what's gone on in the industrial market in the last 10 years, it has completely taken on this new persona. You look at apartments. I mean, look at the amenity arms race that's going on there. They've understood this for a while of, hey, we have to continually evolve and change what this product is in order to fit the current market. And office never did that. They hardly did it at all. And so that's why we have this massive disparity between, those Class C older office complexes that don't even have LED lights, and it's just miserable to be in. The elevator might work sometimes. To these Class A beautiful office buildings that have garage parking, they have restaurants and cafes, they have rooftop decks where you can work from. For the it's a much better offering. You kind of look at it, you're like, well, yeah, of course that's what everybody wants now, even if it costs twice as much.
Yeah. Hey, we got another question here from Rob, who says, if you're comparing two similar deals, what's the one factor that usually makes the biggest difference in long-term returns? And, what do you think on that one, Tyler?
Yeah. So I'm a big believer in finding the emerging corridor, right? I mean, if you're investing where the private equity firms and hedge funds are, and there's massive deals going on already, maybe deals are already trading at 5 caps, you're probably a little bit late to that market, which means it's just going to be very expensive. It'll appreciate, of course. But, again, going back to my corridor by corridor analysis in East Nashville, there's, it's Dickerson Pike, which is where my hotel is. That's where my office building is that I'm here now. It has been underdeveloped compared to the other major corridors near it, but it's still like I'm 8 minutes from downtown Nashville. And so you look at that and you go, okay, we can buy cheaper over here today because your bigger guys have not figured this out yet, or it's quote unquote too early for them, we can buy stuff, improve it, cash flow it, and then ride the appreciation wave once people start to understand what's going on in this corridor. And I'll give you an example of that. Back in 2018, 2019, I started telling investors and developers, because this was when I was just a broker. I had just started raising capital and buying deals in 2019. And I was telling these investors, I was like, hey, you got to start buying land on Dickerson Pike. Like, it is so undervalued. It's overlooked. I think back then it was worth about $1 million to $1.25 million an acre, depending on where you were. They all kept saying, oh, it's too early. It's too early. And it's too early until it's too late every single time. And so we started buying up properties on Dickerson Pike. And then the Oracle campus got announced, 60 acres at the base of Dickerson Pike. The bridge from East Nashville to Germantown got announced, the pedestrian bridge. And then the Titan Stadium got announced. And all of these just massive announcements came in that are all at the base of Dickerson Pike. And it felt like overnight land values doubled. And so you think about that, like if you're investing in an emerging corridor where you're paying attention to the metrics, it's not like we went into a completely unknown territory. All the residential was already being developed. There just wasn't enough commercial to serve it. We were able to ride that. I mean, we had some deals that doubled in value almost overnight without us even having to do anything. So I think that can make the biggest difference long term is how can you let the market work for you while you do everything that you can to make the deal work too?
Yeah. We've seen a lot of success when we're saying what makes two deals different. How do you maximize the value on one? So like the better we can position a deal to be acquirable by the next person, make it so the financials are as clean as possible and they can secure debt on it, right? Make it so that access is as easy as possible. Make it so that if there's any issues with the deal that you've cleaned them up on the title, any of that kind of stuff. So if we make a deal easy to transact on, we're normally able to realize more value out of that outside of the pure fundamentals of, yes, it has to be leased. It's got to be occupied. You have to show strong NOI. So that those parts in there saying those are standard, we got to try and make the deal as clean as possible. And that usually helps our long-term returns better. We run into a lot of deals where we're buying it. Someone's owned the deal a long time, but yet there's some broken easements that aren't quite working. There's some title issue. I'm like, you had a long time to clean this up, and it's going to hurt your value when you try and exit it. So just get that stuff cleaned up. I mean, sometimes it's not the most fun stuff to be doing, but like you've got to get a deal as clean as possible so that it can transact. And that's how we've seen the best, comparing two exactly like kind things. That's really important on maximizing that value on an exit.
Yeah, I mean, that was one of the biggest revelations that I had as a baby investor was leave some meat on the bone for the next guy, because there's this, I don't know, theory or approach in real estate where it's like, let's maximize everything in the deal. Let's do everything and then flip it. That way we maximize our potential sale price. Well, the problem with that is who's going to buy it, right? Like you are so limiting your buyer pool because somebody has to be willing to buy that deal fully stabilized with no value add opportunity, right? Yeah. You leave a little bit of meat on the bone and they can come in and then they can increase by 10 to 20% the rents or whatever that is. Now there's room in it for them to get the returns that they want. So you open your buyer pool up so much more.
Yeah. Yeah. And it makes it like especially in the market right now, you got to be able to attract as many people as possible to buy a deal because the pool is pretty slim out there in a lot of asset classes. So you gotta have things as buttoned up, ready to go as possible, with upside, with a good story for the next person. Because you think like, why would someone buy this? Right. So making that happen is really the part that enables the best returns on the deals we've done. So
yeah. Yeah. And look, you as the seller know more about this property than anybody coming in does. So help them ideate around that. Maybe put some of those plans together, show them some of the things that you decided not to do that you think are easy value add opportunities for the next guy, because it just helps them visualize themselves in that deal that much easier.
Yeah. Yeah. I think going back to the beginning of just like, how do we actually find these deals, and how do you find things that are of value to you to be spending your time on? It's a long-term play of building your communication channels, whether that is you've got a routine of, hey, I'm checking LoopNet every Friday, right? And I'm looking at any expired listings. I have the set brokers that I know I'm going to call and see who I can introduce to, see who I can do tours with, to constantly be getting, what information is out there. And then, I mean, I'm a big fan of like picking a smaller area and focusing on that, instead of saying like, I'm going to tackle America as a whole. It's like, no, pick a city, pick an area, like have some, go back to that what we did last month, and just stick to it, and try and work where you think the value is in your market. I think there's value in every local market that people live in. I think there's always an opportunity there. It's just finding it and talking to enough people to get to it.
Oh yeah, I mean, it surprises people when I tell them like I could invest in only East Nashville for the rest of my life and we would do fine. Like there's enough opportunities there. There's 1,500 or 2,000 commercial properties in the 3 zip codes that I love the most, and all I need is a few a year.
Yeah.
Right. So you don't have to go out and find this massive list, because again, that's the shotgun approach. You're going to have a lot of deals that will never make sense on that list. So narrow it down. So I mean, look, if I wanted to give somebody like action items, like, hey, go do this week, put together a list of 2,000 properties. That's all you need. Like if you're going to go proactively farm them, send out direct mail, door knock, whatever it is, 2,000 properties, because at any given time, 5% are willing to entertain a conversation. So we're talking about 100 opportunities right there. Next, I would go out and I would find 5 to 10 brokers that are transacting the types of deals that you want to be doing in your market, and start touching base with them once every 3 weeks. Every 3 weeks, send them a text, do a phone call, take them out to lunch, build those relationships with them, because that is really what's going to help you. So you've got your buy box from what we talked about last week. You've got your 2,000 properties. You've got your brokers working with you now. It should be very easy for you to go out and find those deals.
Yeah, couldn't agree more. Cool. Well, Tyler, we're going to do office hours on Friday, noon Eastern, just going through. If people have real estate questions, they want to go into specifics on, they've got that list, they've got that deal, they want to talk about it. We're going to do that on Friday at noon. So if anyone could join on that, be excited to. We love just looking at what deals are out there and how they can work.
Yeah, and I think we'll be talking about a couple of the deals that we're looking at, right?
Yeah,
we can show people, give people a little bit of tease. Yeah.
Oh man, we got 6 deals under contract right now, and mostly all of the stuff right now is warehouse and flex underwriting. So you've got some of these are big tenants. We have an 80, 90,000 square foot tenant. The underwriting that goes into, hey, what does the next 10 years look like? You got to underwrite a business. You got to underwrite ownership plans. You got to underwrite, are they going to sell to private equity and consolidate space somewhere? You got to go through all that kind of underwriting of a business before you buy one of those bigger square foot tenants. And then we got a bunch of small tenants that we're looking at too. So we're going to compare and contrast just what those types of deals are like. But we got two good ones that are coming up soon that are going to be one in Greenville, South Carolina, that we're super excited about. Another big, 100,000 square foot flex industrial type deal. So we're excited about going through those.
Yeah, and we've got a deal coming out next week too, right?
We're working on it. That is a plan. It might be a secret until it actually gets released. But yes. So we should have 2 that go out next week that are all in that flex industrial space. So and then we'll go through those on Friday as well. Maybe we go through them early on Friday before we send them out next week.
That'd be perfect. Yeah. So if you guys are interested in investing with us in those deals, jump in, come hang out with us office hours on Friday. We'll talk about them a little bit. We'll show you how to get on the investor list so that you can get access to these deals, so that you can dive into them, look at them yourselves, and hop on the call with us. We'll take it from there.
Yeah, no, all these deals have come from long-term broker relationships that we've had and proven like, hey, if we can get the deal, we will execute. The last thing a broker wants to do is bring a buyer to the table and put it buyer and seller and have the deal blow up, and then go do that again and have it blow up again and not work. They want to know that if they can bring a deal together, that it can actually close. And then that makes the buyer, the seller, and the broker all a little bit happier too, when we can make sure that happens. So a lot of these deals we have are just from long-term relationships that we've been working on and improving ourselves, time and time again. So,
well, that's all brokers care about, right? I mean, look, they don't get paid unless a deal closes. So they want to bring a buyer to a seller that they know, like, and trust, probably have a track record with, that they know is going to close. That way they can get paid.
Yep. All right. Cool. Well, Tyler, this was great. Love going through this stuff. Excited to do our office hours on Friday at noon. And then we'll also have some deal flow at that time. And then we'll have those out next week as well.
Perfect. That sounds good. Appreciate you guys. We'll see you on Friday.
All right. Sounds good. See you, Tyler.